The Nuburu Inc. stock, ticker BURU, is currently trading at approximately 38 cents per share, reflecting a minor intraday move of around 0.01 or 2.65% as of the latest market data, with the market currently open, though trading volumes remain characteristically volatile for a stock of this size. This low price point, trading well under $1, already sets up the tension for this name. Most people see a stock trading this low and immediately think distressed asset or penny stock gamble. That's the common expectation, and it's a fair one given the sheer price and the history of this ticker. However, the unexpected reality is that Nuburu is no longer just the struggling blue laser company you might remember. The company is in the middle of a radical, high-stakes identity shift, morphing from a specialized industrial laser firm into a defense and security technology acquisition vehicle. The real story here is the transformation plan that is aggressively being executed, spearheaded by its new leadership, which is attempting to completely change the firm's focus and salvage shareholder value by shifting from a capital-intensive manufacturing business to a defense-focused integrator with a software and services bent. This is a crucial distinction that most retail investors miss when they just glance at the chart and the sub-dollar price. The expectation is bankruptcy. The surprising reality is a determined attempt at a complete pivot into a sector with high barriers to entry and massive, stable government contracts, particularly within the NATO and U.S. defense structures. The current stock price, therefore, is not so much a reflection of the old blue laser business, which was frankly struggling, as evidenced by the historical lack of significant revenue and deep operational losses, but a deeply discounted future option on the successful execution of this highly ambitious and frankly precarious transformation. Recent stock movement and market narrative. The recent trading action in BURU is a perfect illustration of this tension between the old narrative and the new one. The price is highly volatile, which is absolutely expected for a stock that's undergoing a significant corporate restructuring and primarily trades on future announcements rather than current fundamentals. We've seen a recent spike, followed by a settling back down, but the daily swings are dramatic. This volatility is fueled by a few key, very recent press releases, including the strategic alliance with Maddox Defense for a controlling interest joint venture aimed at next-generation drone technologies, and the announced acquisition of Orbit, a software-as-a-service company specializing in defense and security operational resilience. These aren't small internal product upgrades. These are full-scale strategic shifts with potential access to a massive and highly lucrative defense market. The trading volume, which has been quite high during these announcement periods, tells you that sophisticated speculation, not just retail gambling, is at play here. Institutional activity, though still modest in absolute terms, is notable in its recent changes. We've seen filings showing institutions like Vanguard Group and Geode Capital Management holding positions, with some even increasing their shares. Now, let's be clear, these are tiny allocations for those funds, but their mere presence suggests that this is not a stock to be dismissed as pure noise. They're buying what they believe is a deeply distressed but restructuring stock with a clear new direction. The core belief of the market, the expectation, is still rooted in the past, a micro-cap laser company with a history of financial woes, high price volatility, and substantial dilution, which resulted in the loss of its patent portfolio following a foreclosure. The contrarian and more informed reality is that the new leadership is effectively scrapping the old play and using the public shell and whatever remaining assets and cash they have to aggressively acquire defense and security assets. The recent announcements about compliance restoration with the NYSEAMERICAN after receiving a warning letter further stabilized the stock and removed an immediate existential threat, the very real risk of delisting, which was certainly fueling some of the bearish pressure. This stabilization, though temporary in the grand scheme of the company's financial health, was a critical factor in maintaining the current floor. Investors are essentially asking, will the new defense acquisitions and strategic alliances move faster and generate revenue sooner than the capital burn rate and the specter of past financial mismanagement can sink the company? That is the real trade. The business pivot, blue lasers to defense tech. To understand the company's current position, we need a brief look at where it came from. Nuburu Inc. was originally focused on the development and manufacturing of high-power, high-brightness blue laser technology for industrial applications. Their blue lasers, like the AO150 or the BL250, leverage a fundamental physics advantage. The blue wavelength is significantly better absorbed by highly reflective materials like copper, gold, and aluminum compared to traditional infrared lasers. This makes them ideal for applications like welding and EV battery manufacturing, 3D printing, and high-quality welding for consumer electronics. This was a genuinely interesting technology addressing a real industrial need. However, the path from technical feasibility to large-scale profitable commercialization is long and expensive. The financials confirm this: years of low revenue, negative gross margins, and mounting net losses. The loss of the patent portfolio due to financial distress was the death knell for the original vision and the direct catalyst for the current transformation plan. The new business model is entirely different. The company is building what they call a defense and security hub through acquisitions, particularly in Europe, leveraging strategic relationships to tap into the multi-billion-dollar defense and security operational resilience market. The acquisition of Orbit, a software-as-a-service company, is crucial because it introduces a high-margin, scalable revenue stream, the kind of business that can generate high EBITDA margins, potentially over 40%, which is a stark contrast to the low-margin, high-capital laser manufacturing business. Furthermore, the strategic moves, such as the relationship with the Italian defense company Tecne SPA, which has a significant order backlog tied to NATO and U.S. defense contracts, shows a clear path to generating substantial billings in the short to medium term. The original blue laser technology is not gone. It is simply being repurposed and licensed, or integrated into the new defense vertical, for applications like advanced materials processing in military vehicle and component manufacturing. This model essentially uses the blue laser IP as a technology anchor, while the bulk of the immediate growth is targeted in the defense integration and software services space. It is a highly aggressive and often seen maneuver in the microcap world, abandoning the struggling core to pursue a sector with higher perceived political and institutional tailwinds. This strategy is what provides the company with potential access to capital that a traditional laser company could no longer attract. For those of you who use platforms like Fidelity or Interactive Brokers for your individual brokerage accounts, this is the kind of situation where you need to look beyond the simple ticker information and truly read the 8K and 10Q filings to understand what the company actually is today, not what it was a year ago. Macro pressures and institutional sentiment. The macro pressures on Nuburu are intense, primarily because it's still a microcap with a checkered past. The broader market sentiment towards highly speculative, non-revenue generating SPAC-related entities, which is how Nuburu originally came to market, remains deeply skeptical. However, the shift into the defense sector provides a powerful counter-narrative. Global geopolitical instability and increasing defense budgets across NATO nations and the U.S. are a massive, undeniable tailwind. This is the sector momentum the new management is banking on. When major powers are actively restocking and upgrading their defense platforms, companies with even peripheral access to that supply chain suddenly become interesting. Nuburu's focus on defense and security operational resilience positions it to potentially benefit from this macro trend. The current institutional ownership is a classic microcap snapshot. A small number of institutions hold a limited float, and their positions are often tied to index inclusion or deep value or distressed asset mandates. The crucial detail is not the size of their position, but the increase in positions by some holders in recent quarters, which suggests a belief in the transformation narrative. Meanwhile, the consistent need for additional capital is a massive overhang. The company has had recent follow-on equity offerings, which are fundamentally dilutive and suppress the stock price, keeping it firmly in the sub-dollar territory. This capital is necessary to fund the acquisitions, like the Tecne and Orbit deals, and this dilution is the reality that tempers the expectation of a sudden, parabolic defense tech run. A key risk to the current strategy is the ability to complete and integrate these acquisitions successfully, particularly the complex cross-border Tecne deal, which requires Italian golden power clearance. Failure on that front would shatter the entire transformation narrative and send the stock into a spiral. The market is waiting for those definitive completion announcements, and until then, the stock remains a high-wire act of speculation. This is why careful self-investing or using a managed option like Schwab Intelligent Portfolios or a platform with robust research tools, such as the ones available through Fidelity Investments or the Interactive Brokers trading platform, is so important for these riskier names. You need real-time data and access to filings, not just news headlines. Future outlook, catalysts, and risks. Looking ahead, the future outlook for Nuburu is a binary outcome, extraordinary success or failure with little middle ground.